How is everyone doing today? Welcome back to another episode of The Banker Next Door. I'm your host, Dr. Joe Berquist. Today, I wanted to get everybody an update on the commercial real estate maturity wall. What is happening with that? Things are shifting around a little bit. I want to take a look at two articles today from S&P Global. The first one, we're going to take a look at loan modifications. There's a little change that was made there and how that could affect basically transparency with banks' delinquent commercial real estate loans. So we're going to take a look at that. And then I have an article looking at the commercial real estate maturity wall. The maturity wall is basically something that came up starting a couple of years ago. So when the Fed went into their tightening interest rate cycle, meaning that they were increasing interest rates, when that happened in 22 to 23, that dramatic increase in interest rates made it very difficult in certain circumstances for banks to either renew or to roll over existing commercial real estate loans, which means that they went into a mode of something that was called extend and pretend. And this became a big issue over 24 into 25 as what became known as the maturity wall. Basically, this giant amount of commercial real estate loans that were going to come due in 25, 26, and 27. And the big question, banks, of course, out there praying that interest rates were going to come down. Now, they have come down a little bit and it's helped, but they certainly aren't anywhere near where a lot of those loans were originally booked, meaning at the 3.75, 4%, 4.25, maybe even 4.5%. A lot of these customers are looking at rates right now much, much higher, looking at rates at probably 6.25, 6.5, 6.75 today. And this is making it somewhat difficult to roll this debt over because some of these tenants don't have the rent roll to support the increased debt load. So with that being said, let's take a look at these two articles real quick, because I just wanted people to understand this modified loan reporting and how this plays in. So modified loan reporting change to cloud investors' view of bank credit quality. So an impending change in the way regulators require banks to report modified loans will obscure a key window into credit quality for investors, according to experts. When banks modify loan terms to help distressed borrowers stay current on payments, regulators require them to report the total amount of such loans for the life of the loan on their quarterly call reports. But starting on December 31st, that'd be December 31st of this year, banks will only have to report loans modified in the last 12 months, making the credit quality measure what investors can use to assess bank credit quality more clouded. It absolutely makes the financial condition of the banks more opaque, which means that investors can rely upon what's publicly available in the call reports, former Federal Reserve staff economist Rebel Cole said in an interview. The change comes at a time when the bank industry's total number of modified loans is on the rise, reaching 80.93 billion at the end of the second quarter from 57.32 billion in the first quarter of 2024, according to S&P Global. The proportion of modified loans that are delinquent is also on the rise, with total delinquent modified loans at 23.35 billion compared to 17.17 billion as of June 30th, 2024. Now, I just want to point out something small here. So when a bank in the past, years ago, used to modify a loan, that was basically, it had to get put on the bank's books as what was called a TDR, a troubled debt restructuring. Banks hated that label. They hated the TDR label, because even if you were actually helping a customer and that customer was going to be for the better in the long run, they had to basically put this TDR label on it, which was basically like a black eye. And then that TDR had to show up in every quarterly call report. That TDR would be there. And what would happen is, the bank CEOs, the bank CFOs, at a certain point, they would get tired of talking about said loan that was a TDR that basically was just going to sit there for years and years and years. So it could become a point of contention, to the point where, a bank would basically go back to that customer and say, hey, we really like it if you go refinance this loan with another bank, basically just so we could get this TDR off our books. It's like I said, it's kind of a messed up thing, but that's the way it used to work. Now, CECL comes into play. So the current expected credit loss is basically the new way of banks to calculate their loan loss provisions. So CECL comes in, and one of the big things that was basically paraded with CECL was like, oh, hey, we could kind of get rid of the TDR. That kind of happened, but not totally. And that has kind of led us to today. So now we have on the call reports, basically banks are not only going to have to report what loans they've modified in the last 12 months. So basically anything that was modified before that is going to fall off, which, again, and, so you could see here from 24, from this chart here, you can see the number of loans that have been modified here throughout the first 4 quarters of 24, first 2 quarters of 25. And, we could see that it's an increasing number of modified loans, and then go down. And we basically get back into the banks with the most modified loans and leases for the second quarter of 2025. And you can see here Bank of America, Capital One, Wells Fargo, JP Morgan, Truist, US Bank, American Express, Santander, PNC Bank, PNC Financial, kind of the usual suspects. But again, I would just point out on this chart here, not an insignificant amount of modified loans, pretty substantial amount of modified loans. So I just wanted to point out this change because it's small and yet can be substantial at the same time. Now, let's get into our discussion on the extensions. So this article is called "Extensions Shift the CRE Maturity Wall, but 2026 could now be a tougher year." So as in prior years, extensions were a key thing for the U.S. commercial real estate market in 2025, which can be seen in our recently updated maturity wall model. The model estimates the amount of CRE debt maturing in coming years and, through a comparison of estimates over time, illustrates the trend of lenders offering extensions. The increase in maturing debt that the model predicted in 2024 now appears set for 2026, with an 18.8% jump compared to 2025. So, what does this mean? Well, as you can see here from the chart, the amount of U.S. commercial real estate mortgage estimated to mature based on amounts at origination, you can see that the original maturity wall was set up for 25, 26, and 27. And for the most part, that still holds true. But now you kind of look out a little bit further on the horizon, and 2028, especially 2029, and then 2030, I mean, you've got a lot of loans going to mature here over the next 5 years, and it's going to increase. So a lot of focus now starting to come in on 2026, and 2026 again looking like a much tougher year. Now, I think the reality of the situation has really kicked in the sense that banks know that they can't really kick the can down the road anymore. And I think borrowers have basically realized that, what? Yeah, we're not going back to 3.5% or 4% interest rates. We're back in a what I would call a normal time again, where interest rates may go back down into the fives. But I think for the most part, we could be looking at an environment where we stay in the sixes for quite a while. So we'll have to see. But the reality is, these loans are going to have to be rolled over at higher interest rates, and does that lead to more delinquency over the next couple of years? So what is the take here? So lenders have been extending CRE loans that are about to mature, which helps borrowers avoid a big interest rate shock and buys lenders time for interest rates to fall. The strategy appears to be working for banks based on delinquency ratios, but S&P Global believes this credit cycle is not over yet. The jump in maturing debt previously predicted for 2024 now appears to be coming in 2026, but we see no reason why lenders could not continue offering extensions. Banks accounted for nearly 60% of the originated CRE mortgages maturing in 2025 per our newly built classification model. But that ratio is projected to decline in the next 5 years as banks have been dialing back their exposure. Private credit has been playing a bigger role in the CRE market, taking market share from traditional lenders, but banks have also partnered with private credit firms to invest in CRE, which can be seen in the substantial increase in lending to non-depository financial institutions. So, and then it goes on to say, spikes in the maturity wall are indications of potentially challenging years, as higher interest rates coupled with more scrutiny towards CRE loans could make it harder for borrowers to secure fresh financing at an affordable rate. Based on the loan level data, borrowers would face a nearly 150 basis point increase were they to secure a new loan in 2025 relative to the rate that they were paying on their maturing loan due to the Federal Reserve's swift interest rate tightening in 2022 and 2023. That is an improvement from 2024, however, when the gap was closer to 200 basis points. So, like as I was saying, 4.5 to now, or if you were at 4.5, maybe now you're at 6%. Maybe. I still think that's a little low. I still think you're looking at probably a gap closer to 200 basis points, even with the rate coming down. But I just want to point out a couple of things here real quick. Number one is, it said they just say that, like, oh well, they could continue to extend these loan maturities. They don't see any reason why they can't. I see an enormous reason why they don't want to extend the maturities, because banks are, banks have to worry about their profitability. They have to worry about their profit margins. They have to worry about the spread. And if you've got a loan sitting on your books at 4% or 4.25, and the going rate is say 6.25, that's 200 basis points that you're leaving on the table right now that you could be getting from that customer, and you're not. And that doesn't usually sit well with a lot of bank CEOs and CFOs that are basically looking at that. Again, they're in a relatively weaker lending environment that we've had for the last year and a half. You're looking at the low hanging fruit, and you're going, what's the easiest thing for me to do? Well, the easiest thing for me to, so say you got $1 million mortgage, and again, that mortgage is at 4%. And you could get that up to 6.25% or 6.5%. Simply, all you got to do is renew the interest rate, and boom, you automatically make more money off an existing customer. You don't have to do anything else. It's a lot cheaper and easier to do that than it is to go out and procure a new customer. It costs much more to attain a new customer than it does, or to acquire a new customer, than it does to retain an existing one or charge an existing one more money. So I see a massive reason why right there that they don't want to keep just kicking the can down the road. The other thing is that when you have loans at 4%, again, and the market's at 6.5, what does that mean? That means that your loan is now underwater. In other words, if you were to sell that loan or lay it off, you're going to get less than par value. You're going to get less than 100 cents on the dollar. You may only get 90 cents on the dollar, or you might get 80 cents on the dollar. That is not good for a bank's overall loan portfolio over time. You don't want that. And then finally, with the private credit piece of this. So a lot of banks have been dumping their loans into the private credit market. It has it not, again, not that their customers necessarily want that, but the bank looks at it like, well, we're dumping risk off into the private credit market, and the private credit market is happy to have it. Now, the private credit market is not cheaper. They're not cheaper than banks. They're maybe a little bit more lenient in their loan terms, and maybe some of the things that they do, but their rates and fees are going to be higher than what banks actually charge. So that's not actually helping the customer. But I've been maintaining for a while that banks think that they're going to hide their credit risk, especially the bigger banks, by dumping off a lot of these commercial real estate loans into the private credit market. And, that's not going to play out so well. So, but again, I just wanted to show everybody, I wanted to give people an update just to talk about this change in how banks have to discuss in the quarterly reporting of their delinquent or modified loans, and how basically anything that's modified over a 12-year period, over the 12-month period, is going to drop off. So that could affect how you look at a bank's true level of delinquency or modified loans in their loan portfolio. And then the maturity wall here obviously is going to increase, continue to be an issue in the banking industry, and we're definitely going to have to keep an eye on this as it moves forward. So, but with that being said, we're going to wrap up by saying, if you like this episode, please make sure to like, share, and subscribe. That always helps the channel. Remember, we are on YouTube, Rumble, and all major podcast platforms. Please be sure to leave your comments down below, as I love getting back to everybody. And as always, make sure to check out some of the other content on the channel. I hope everyone has a great day out there. I thank you for listening, and I will see you again real soon.